Hey there, and welcome back. It's James here, and in this video, I want to talk about stock splits because it occurred to me recently that a lot of people don't actually understand what a stock split is and how much impact it actually has on the market. So, for example, let's take a look at Netflix. Netflix is currently trading at $104.31 as of November 22nd, 2025. If we look down the bottom of trading view, there's this orange S. And if I click on it, it says split 10-1. This is a way that the powers that be manipulate retail traders and manipulate the market. Because in reality, before this split, this stock was 10 times higher. And I don't mean the stock fell 90%. I was having a little bit of a hard time figuring out the best way to explain this, so I decided I would rely on an AI to help me give you an illustration. So let's just read this together, and I'll kind of give you my 2 cents on it. It says, think of a stock split like cutting a pizza into more slices. You start with a pizza that's cut into 8 slices, and that's your original stock. You own 2 slices, which is 25% of the pizza. So think of 2 shares. Think of the pizza as a company. It has 8 shares total float. That's all the shares available, and you own 2 of them. Now imagine cutting each slice in half, creating 16 smaller slices. You now have 4 slices, because if you own 25% of the shares in a company, and we're using 25% even though you're almost never going to own that much, but if you own a percent of a company, when they split, you still own the same percent of the company, you just have more shares. So in the example of the pizza, it's been cut into 16 slices, so you now have 4 because you own 25% of those 16. The pizza didn't change, it didn't become bigger or smaller. It didn't, get more toppings or less toppings or extra cheese. It's the same pizza. Everything's the same. It's just cut into smaller slices. This is what happens in a 2-for-1 stock split. If you own 100 shares at $200 each, it's a $20,000 total. After a split, you'd own 200 shares at $100 each, which is a $20,000 total still. You have twice as many shares, but they're worth half as much per share. Now, this is where it gets really, really nefarious. The $100 price feels more affordable than $200, even though the value that you're buying is identical. It's like going to a store where everything costs $50 versus a store where everything costs $100. Your brain instinctively categorizes the first store as cheaper, even if the $50 items are half the size. This triggers a whole unit bias. People psychologically prefer owning whole shares rather than fractional shares. By the way, we see this in Bitcoin all the time. I'll talk about that in a moment. A $100 stock feels more accessible than a $200 stock, even though you can invest the same dollar amount in either. It's the difference between buying 1 share versus 0.5 shares. Even though mathematically it's identical, it feels different. Companies split their stocks specifically to tap into this psychology, making their shares feel more retail friendly and attracting small investors who might have been intimidated by a higher price tag. Put simply, guys and gals, this is market manipulation. Before this stock split, it was over $1,000 per share. And so it felt expensive. And that means that a lot of retail would avoid this stock altogether because it just felt too expensive for them. The same way that Bitcoin feels too expensive at over $100,000. But when Netflix decided to split the stock by 10, what happened is everyone who was holding 1 share now has 10 shares, but those shares are worth 10% as much. So if they have 1 share that was worth, $1,000, now they have 10 shares that are worth $100 each, or in this case, 10 shares worth $104, whereas 1 share was worth $1,040. So what it does is it creates this buying pressure because people feel like the stock is on sale. They've been seeing it for months at hundreds or thousands of dollars, and now suddenly they can get it for $104, and they don't realize they're actually buying a much smaller piece of the company. Another example that I will use is candy bars. When I was a kid, we would go fishing on the weekends when I was really young. My dad would take us fishing every weekend, and we would stop down at the local grocery store, and they would have Snickers bars 4 for $1. So they're 25 cents a piece. They're like 2.5 ounces per bar. If I went to the store today and I bought those, of course, they're much more expensive than that. But let's just say hypothetically that I could still buy them 4 for $1. If I look at the wrapper, a Snickers bar now is like 1.8 or 1.9 ounces versus they used to be like 2.8. So I'm getting less for my money. And we see this in the like grocery stores. They even coined a name for it. Analysts call it shrinkflation, where a product costs the same amount today that it cost 5 years ago, but the amount you're getting, the package, is actually smaller, or it's the same size box, but with a lot more air in it. That's what they're doing in the stock market. It's absolutely critical that you understand this because it's horrible market manipulation. Looking at Amazon, Amazon did a 20-to-1 split, which means that their stock, for every 1 share you held back here, they exchanged it for 20 shares, which means that the stock lost 95% of its value per share. So on the stock, it's like $220 doesn't sound too bad for Amazon until you consider that it's actually $220 for 1/20th of a piece of the company of what you used to be able to buy it for, if that makes sense. If they hadn't split, each share would currently be $4,413, and the average retail investor would not have any interest in buying a $4,400 stock. So they split it to make it seem cheaper, but you're actually getting much, much less. It's shrinkflation in the stock market, essentially. Tesla is another example, and this is very common. I bought Tesla for the first time ever in August of 2019, and I believe the number I paid was like $200 and something. But now the chart says it was only 15 back there. And that's because 1 share of Tesla now represents a much smaller ownership stake in the company. It's split here 5-to-1, and then it's split here 3-to-1. So if you owned 1 share here, it became 5 shares, and then those 5 shares split again and became 15 shares. So realistically, $391 times 15 is what it would really be worth if they hadn't split. So for example, back in August of 2019, price was around $15 on this chart. I said I paid 2 something. Well, 15 on the chart times 15, $225 a share. And I think I actually paid like $228 is what I bought it for back there. But again, now this seems like, well, it's only $391 and it used to be much, much higher. Again, that's because it's split. Because right here, when it split 5-to-1, it was $168 after the split. Before the split, it was like $900 a share. See, cryptocurrency doesn't do this. It doesn't split. And that's why Bitcoin is worth $100,000 plus, or well, today it's worth around 85,000, but it was worth over 100. If they could split Bitcoin, you'd probably get even more buying volume because people would get excited about owning Bitcoin. But one of the problems that works against Bitcoin is you can't split it. Yes, it's divisible down to the Satoshi, but I mean, you can't change what 1 Bitcoin is worth as far as percentage of total supply. 1 Bitcoin will always be 1 of 21 million Bitcoin. You can't just suddenly say, well, we're going to issue new Bitcoin. Now there's, 100 million Bitcoin, but we'll give you 5 Bitcoin for every 1 Bitcoin you own. But that's what companies on the stock exchanges do all the time. They just increase the total number of shares, so each share is a tinier piece of the company. So again, think about the Snickers bars. They used to be almost 3 ounces per Snicker bar. Now they're like 1.8. So even if something costs the same, you're getting less for your money. Stocks work exactly the same way.